The accumulation phase, as meticulously described by Richard Wyckoff, is a critical period in the market cycle, representing the strategic, stealthy buying of assets by large, informed investors after a prolonged downtrend. This is not a random occurrence, but a carefully orchestrated process by the composite man. Wyckoff's metaphor for the collective actions of large institutional players, who systematically absorb supply from weaker holders. Identifying this phase is paramount because it precedes the significant upward price movement known as the markup phase, where the smart money reaps substantial profits. The accumulation process can be broken down into 5 distinct yet interconnected phases, each characterized by specific price and volume behaviors that offer clues to the discerning trader. Phase A, stopping the prior, downtrend, marks the initial stage where the relentless downward pressure begins to wane and the first signs of buying interest emerge. This phase effectively halts the prevailing bearish trend. The first event often observed is preliminary support, where noticeable buying activity appears after a significant decline, causing the price to stabilize temporarily. This is usually accompanied by an increase in volume, signaling that larger players are beginning to step in and absorb some of the selling pressure. While not necessarily marking the absolute low, it provides the first hint that a shift in sentiment might be underway. Following preliminary support, the market typically experiences a selling climax. This is a dramatic event characterized by a rapid, often panicked decline in price, reaching new lows on extremely high volume and wide price spreads. News surrounding the asset is usually overwhelmingly negative, pushing retail investors into capitulation. This intense selling pressure often creates a spike on the chart, representing the exhaustion of supply from weak hands. Crucially, the composite man is actively buying into this panic, absorbing the massive sell orders. The sheer volume indicates a significant transfer of ownership from the emotional sellers to the strategic buyers. Immediately after the selling climax, an automatic rally typically ensues. This is a sharp, often rapid, rebound in price that occurs as the intense selling pressure subsides, and buyers, who had absorbed the climax, temporarily dominate the market. The automatic rally's high point establishes the upper boundary of the emerging trading range, while the low of the selling climax forms the lower boundary. This bounce confirms that demand has, at least temporarily, overcome supply. The automatic rally is a natural reaction to the extreme oversold conditions created by the selling climax. Finally, within Phase A, we observe the secondary test. This occurs when the price returns to the vicinity of the selling climax low, testing the market's ability to hold that support level. During a secondary test, the price may retest the low or even slightly exceed it, but crucially it does so on significantly lower volume than the selling climax. This reduced volume indicates that the supply that characterized the selling climax has largely been absorbed, and there are fewer sellers willing to push prices lower. A successful secondary test, where the price holds above or near the selling climax low with diminished volume, confirms that the selling pressure has abated, signaling the end of Phase A and the beginning of the more prolonged accumulation process. It acts as a confirmation that the downtrend has likely been arrested. Phase B, building the cause for the future. Move, is often the longest and most complex part of the accumulation process, characterized by a prolonged period of sideways price movement within the established trading range. During this phase, the composite man is systematically accumulating the vast majority of their desired position. The market will typically fluctuate up and down, testing both the upper and lower boundaries of the trading range established in Phase A. These oscillations serve to shake out any remaining weak holders and allow the smart money to accumulate at favorable prices. Throughout Phase B, traders will observe multiple secondary tests of both the support and resistance levels. These tests can sometimes create slightly higher highs or lower lows within the overall trading range, making the boundaries appear somewhat fuzzy. The key characteristic to watch for is the volume behavior. Volume tends to decrease on the downward movements within the range, indicating a diminishing supply, and increase on the upward movements, suggesting increasing demand. This subtle shift in volume dynamics is crucial, as it signals the underlying strength of the accumulation. The composite man is meticulously building their cause, a solid foundation of accumulated shares that will fuel the subsequent effect, the markup phase. This phase can be frustrating for impatient traders due to its prolonged nature and lack of clear directional momentum, but it is absolutely essential for a powerful future move. Phase C, the final test of supply, is a pivotal moment in the accumulation process designed to confirm that virtually all remaining supply has been absorbed by the composite man. This phase is often characterized by a decisive yet deceptive move that shakes out the last of the weak holders. The most common event in Phase C is a spring or a shakeout. A spring occurs when the price briefly drops below the previous lows of the selling climax or secondary test, often on high volume, only to quickly reverse and move back into the trading range. This move is designed to trick bearish traders into shorting the market and to scare remaining long holders into selling their positions. The purpose of the spring is twofold. First, to spring the trap on late entering bears, forcing them to cover their shorts at higher prices, and second, to absorb any last vestiges of supply from those who might still be holding onto their shares. The swift recovery back into the range, often on increasing volume, confirms that the supply below the support level was quickly absorbed. An alternative scenario in Phase C is a market that advances without a spring, which can happen if the demand is so strong that there is no need for a final shakeout. In such cases, the price simply begins its upward trajectory from within the trading range, signaling that accumulation is complete without a dramatic downside test. Regardless of whether a spring occurs, Phase C is about confirming the dominance of demand over supply. Phase D, transition from cause to effect, marks the critical shift from the accumulation phase to the markup phase, where the composite man begins to drive prices higher. This phase is characterized by clear signs of strength and a definitive break from the established trading range. The first significant event in Phase D is often a sign of strength. This is a rally that decisively breaks above the upper boundary of the accumulation trading range, often accompanied by strong volume. This move indicates that demand has finally overcome the supply that had been holding prices down. Following a sign of strength, the market typically experiences a last point of support. This is a corrective pullback that occurs after the initial breakout, where the price retests the former resistance level, now acting as support. Crucially, the last point of support forms a higher low than the previous lows within the accumulation range and occurs on significantly lower volume. This confirms that the market has successfully transitioned, and the former resistance has indeed become a new, higher support level. The last point of support offers an excellent low-risk entry point for traders who missed the initial sign of strength. Throughout Phase D, traders will observe increasing volume and volatility on upward moves, confirming the growing dominance of demand. The market is now clearly signaling its intention to move higher. Phase E, breaking out of the range and beginning the uptrend, is the final and most rewarding phase for those who correctly identified the accumulation process. This phase is characterized by a clear and sustained breakout from the accumulation trading range, initiating a new, robust uptrend. The price action in Phase E is driven by overwhelming demand, which now significantly outweighs any available supply. The composite man has completed their accumulation and is now actively pushing prices higher, capitalizing on their carefully built positions. During Phase E, the market will exhibit strong upward momentum, with prices making consistent higher highs and higher lows. The volume typically remains strong on upward moves and recedes on any minor pullbacks, confirming the health of the new trend. This is the markup phase, where the profits from the strategic accumulation are realized. Traders who entered during Phase C or D will now see their positions move significantly in their favor. Understanding the progression through these 5 phases of accumulation provides a powerful roadmap for anticipating and participating in major market upswings, turning complex price charts into readable narratives of institutional intent. We have explored the profound insights offered by Richard Wyckoff's methodology, from his fundamental laws to the intricate dance of the accumulation phases. Now let's translate this theoretical knowledge into actionable strategies with 3 practical steps you can implement in your trading immediately. These steps are designed to simplify the complex Wyckoff framework, making it accessible and effective for identifying high-probability trading opportunities. By systematically applying these principles, you can gain a significant edge, understanding market movements with greater clarity and confidence. Step 1. Identify the current market phase and its structure. This foundational step involves zooming out to gain a broader perspective of the market's context. Begin by determining the global trend of the asset you are analyzing. Is it in an uptrend, downtrend, or is it currently consolidating? Identifying the dominant trend helps you frame your analysis. Once the overall trend is understood, focus on identifying specific trading ranges or consolidation areas. These are the zones where the composite man is likely accumulating or distributing. Look for the characteristic events of Wyckoff's Phase A: the selling climax, the automatic rally, and the secondary test. These events are crucial because they define the initial boundaries of your potential accumulation range. The low of the selling climax and the high of the automatic rally often serve as the first approximations of support and resistance. Accurately recognizing these key events allows you to draw preliminary lines on your chart, outlining the battleground where smart money is operating. It's not just about drawing lines, it's about understanding the narrative behind them. Consider where the asset is in its broader cycle. Is it emerging from a prolonged downtrend, making accumulation a strong possibility? Or is it at the top of a long uptrend, suggesting distribution might be underway? Context is everything. A clear understanding of the market's structure and its specific Wyckoff events will provide the canvas upon which your detailed analysis will be painted, giving you a strong foundation for the next steps. Without this contextual understanding, individual price movements can seem random and misleading, but with it, they become part of a logical, predictable sequence. Step 2. Analyze the interaction of supply and demand using volume and price action. This step delves into the heart of Wyckoff's methodology, focusing on how price and volume tell the story of the ongoing battle between buyers and sellers. Apply the law of supply and demand by meticulously observing volume alongside price movements. When the price is rising, is it accompanied by increasing volume indicating strong demand or decreasing volume suggesting a lack of conviction? Conversely, when the price is falling, is it on high volume heavy supply or low volume weak selling pressure? These observations are critical. For instance, a strong move up on high volume is a healthy sign of demand, while a weak rally on low volume could be a test to see if supply remains. Next, utilize the law of effort versus result to identify harmony or divergence. A harmonious relationship is when strong effort, high volume, leads to a significant result, large price movement. A divergence, however, is when effort does not match result. For example, if the price makes a new low in the trading range but on much lower volume than previous lows, it suggests that the selling effort is diminishing and the market is becoming oversold in a healthy way, meaning supply is drying up. Conversely, if price attempts to rally but volume is very low, it indicates a lack of buying interest. This step also helps in identifying potential manipulative moves, such as a price drop below support that quickly reverses on low volume A spring, designed to shake out weak hands before the true markup begins. Consistently analyzing these relationships provides deep insights into the market's true underlying strength or weakness, helping you differentiate genuine moves from traps. Step 3. Determine optimal entry and exit points based on key Wyckoff events. This is where your analysis translates into concrete trading decisions, focusing on maximizing potential returns while minimizing risk. For entries, look for confirmation of Phase C events, particularly after a spring or a shakeout that successfully re-enters the trading range. A spring, followed by a quick rebound and a test of the previous support on low volume, provides a high probability, low-risk entry point. Another excellent entry opportunity arises during Phase D at the last point of support. After a land sign of strength, has broken above the accumulation range. Here, the former resistance becomes new support, and a pullback to this level on diminishing volume offers a clear entry with a well-defined stop loss. Your stop loss should always be placed below a significant Wyckoff event low, such as the low of the spring or the last point of support, providing protection against unexpected reversals. For exits, plan your profit targets using the law of cause and effect. Measure the horizontal extent of the accumulation range, the cause, to project the potential effect, the subsequent price movement during the markup phase. The longer and wider the accumulation, the greater the potential upside target. Use volume to confirm breakouts and reversals. Strong volume on a breakout from the accumulation range confirms the validity of the move, while decreasing volume as the price approaches your target might suggest exhaustion. This systematic approach to entries and exits, grounded in Wyckoff's principles, helps you manage risk effectively and capture substantial profits during the markup phase. Navigating the complexities of market cycles requires more than just identifying patterns. It demands a deeper understanding of the underlying forces at play. Richard Wyckoff's methodology, while robust, also presents several nuances and deeper aspects that enhance its power when properly understood. These elements often differentiate a superficial application of the method from a truly masterful one. Grasping these finer points allows traders to interpret market behavior with greater sophistication, moving beyond simple checklists to a more intuitive comprehension of market psychology and institutional intent. One of the most profound concepts in Wyckoff's teachings is the composite man. This is an imaginative construct, a metaphorical entity representing the collective actions of large professional operators, institutional investors, and all other significant players who strategically influence market prices. The composite man is always planning, executing, and concealing their true intentions. By personifying the market this way, Wyckoff encouraged traders to think like these large operators, to anticipate their moves, and to trade in harmony with their strategic objectives. This perspective helps in understanding why certain price actions occur, even if they seem counterintuitive at first glance. The composite man's goal is to accumulate at low prices, then distribute at high prices, and the entire Wyckoff cycle reflects this strategic game. The significance of volume cannot be overstated within the Wyckoff framework. Volume is not merely a secondary indicator. It is the fuel that drives price movements and a critical gauge of the composite man's activity. High volume indicates significant participation and effort, while low volume suggests a lack of interest or the absence of strong conviction. For example, a price breakthrough on high volume is a powerful confirmation, signaling strong institutional backing. Conversely, a price rally on low volume may be a test to see if supply is present, or a sign of weakness, indicating that the move lacks genuine support. Learning to read the interplay between price and volume provides invaluable clues about the sincerity and sustainability of any market move. It helps to validate or invalidate the observed price action. However, it is crucial to acknowledge the subjectivity of interpretation when applying Wyckoff's method. While the principles are logical, their application to real-time charts often requires experience, judgment, and flexibility. Market patterns are rarely perfectly textbook. What one trader identifies as a spring, another might see as a simple breakdown. The ability to correctly interpret Wyckoff events comes with practice, careful observation, and a willingness to adapt one's analysis to the unique characteristics of each asset and time frame. This subjective element means that no two traders will interpret a chart exactly the same way, but consistent application of the core principles improves accuracy over time. Developing this interpretive skill is a journey, not a destination, requiring continuous learning and refinement. Despite its origins in the early 20th century, Wyckoff's methodology demonstrates remarkable adaptability to modern markets. Conceived for analyzing traditional stocks, its underlying principles of supply and demand, cause and effect, and effort versus result are universal. They apply equally well to commodities, forex, and even the highly volatile cryptocurrency markets. The fundamental human emotions of fear and greed, and the strategic actions of large players, remain constant across all asset classes and time frames. This timelessness is a testament to the robustness of Wyckoff's insights. While the speed and technology of modern markets have changed, the core principles governing price movement driven by institutional interest have not. Wyckoff's framework provides a consistent lens through which to view these diverse markets. Finally, it is important to understand the limitations of the method. While Wyckoff provides a powerful framework for understanding market dynamics, it does not offer a crystal ball. The actions of the composite man are by nature opaque, and directly tracking every move of large players in real time is impossible. The method relies on interpreting their footprint through price and volume. There will be false signals, and markets can behave unexpectedly. Therefore, Wyckoff's analysis should always be combined with sound risk management, position sizing, and a comprehensive trading plan. It is a powerful analytical tool, but not a standalone predictive oracle. Recognizing these limitations encourages a balanced and realistic approach to trading, preventing overconfidence and fostering continuous learning. Understanding Wyckoff's nuances and deeper aspects transforms his method from a simple set of rules into a sophisticated art form. It empowers traders to think critically, anticipate institutional moves, and navigate the markets with a profound sense of purpose. For any trader serious about mastering the market, the journey of continuous learning is paramount. This deep dive into Wyckoff's accumulation phases is just one step on that path. If you're looking to consistently improve your strategies, understand the psychology behind market movements, and learn from the best in the business, you'll find immense value in exploring further. Our channel, Trading Insights, is dedicated to dissecting the strategies, methods, and principles of successful traders, speculators, and investors, offering you actionable knowledge to refine your own approach. From detailed technical analysis to nuanced risk management, Trading Insights provides a comprehensive resource for elevating your trading game. But understanding the how of trading is often incomplete without grasping the why and the historical context that shapes today's financial landscape. For those fascinated by the rich tapestry of financial history, the dramatic events, and the legendary figures who shaped Wall Street, our sister channel, Wall Street Memoirs, offers an unparalleled experience. Dive into captivating narratives of historical market events, profound financial crises, and the lives of the titans who built and sometimes broke the financial world. Understanding the past can provide invaluable perspective on current market dynamics, helping you recognize recurring patterns and avoid common pitfalls. Together, Trading Insights and Wall Street Memoirs create a holistic educational ecosystem, equipping you with both the practical skills and the historical wisdom needed to truly excel in the financial markets. Don't miss out on these incredible resources. Make sure to check out both channels today. In conclusion, Richard Wyckoff's methodology, developed over a century ago, remains an unparalleled framework for understanding the underlying logic of market cycles and the strategic intentions of large institutional players. His insights into the accumulation phase, broken down into distinct stages, provide a powerful roadmap for anticipating significant upward price movements. By diligently applying his three fundamental laws, the law of supply and demand, the law of cause and effect, and the law of effort versus result, traders can gain a profound analytical edge. These principles allow us to see beyond the superficial noise and interpret the true narrative unfolding on our charts. We have explored how to identify the market's current phase and structure, recognizing key Wyckoff events like the Selling Climax, automatic sort, rally, and secondary test to define the boundaries of accumulation. Furthermore, we've delved into the crucial analysis of supply and demand dynamics, using volume and price action to discern the composite man's actions and distinguish genuine strength from deceptive weakness. This meticulous observation of effort versus result is what uncovers the market's true intentions. Finally, we've outlined how to determine optimal entry and exit points, leveraging the confirmations provided by Phase C events like the Memoirs and Phase D events such as the last point of support to manage risk effectively and maximize profit potential. The mastery of Wyckoff's method is not achieved overnight. It requires consistent practice, critical thinking, and a disciplined approach to market analysis. It demands that you think strategically, anticipating the moves of the composite man, rather than reacting impulsively to every price fluctuation. By continuously refining your ability to interpret price and volume, you will develop a deeper, more intuitive understanding of market behavior. This profound knowledge empowers you to make more informed trading decisions, enhancing your confidence and consistency. Embrace these practical steps, commit to continuous learning, and let Wyckoff's timeless wisdom guide you toward greater success in the financial markets. For those eager to delve even deeper into the original source of this invaluable knowledge, to absorb the wisdom directly from the master himself, there is an indispensable resource. Richard Wyckoff's seminal work, How I Trade and Invest in Stocks and Bonds, offers an unparalleled opportunity to study his time-tested methods firsthand. This adapted edition provides a comprehensive guide to his strategies for analyzing market trends, deciphering the intentions of large players, and making well-reasoned trading decisions. It's not just a book. It's a mentorship in print, revealing the foundational principles that have stood the test of time. To truly internalize Wyckoff's approach and elevate your trading to an expert level, acquiring and studying this classic text is an essential next step. Find the link to this transformative resource in the description below, and embark on a journey to trading mastery.